Hello, this is MyTam Television exploring United States stocks. Today we'll be covering a blue chip stock in our analysis segment, and the company I'll introduce is Advanced Reduced Instruction Set Computer Machines Holdings. The ticker symbol is Advanced Reduced Instruction Set Computer Machines. It was a very hot company even at the time of its initial public offering, and it still is. I'll explain based on data whether this company is truly a blue chip, what its future earnings outlook looks like, and what the current stock momentum is, along with some forecasts. I'll be explaining these things to you using data from the choice stock system that we operate. In the case of Advanced Reduced Instruction Set Computer Machines Holdings, it's a company that creates semiconductor intellectual property by designing central processing unit architectures. This company doesn't manufacture and sell products, but rather sells things like blueprints or designs. So they provide IP that allows others to quickly design semiconductor chips using those blueprints. So not only big semiconductor companies, but also companies in mobile, automotive, and other fields that design semiconductor chips are their main customers. Advanced Reduced Instruction Set Computer Machines Holdings is the company that provides these kinds of services. Let's take a look at them one by one. If you look at the stock trends over the past 52 weeks over the past year, most of the stocks have shown similar patterns. Starting from the end of last year until March and April of this year, stock prices dropped sharply, falling by about 56%. Since then, they've rebounded and have risen by about 80% compared to that low point. So when it dropped, it was 56%, and when it rose, it was 80%, but it still hasn't surpassed its previous high. So what that means is if the stock price drops by 50%, it actually needs to double from that point just to get back to its previous high. If it drops by 50% and goes from $100 to $50, then to get back to $100 from $50, it has to double. So if it drops by 50%, you need a 100% return to recover. That's how you can recover your principal. So if the stock price drops by 50% after you buy it, it will likely take a long time to recover. So when stock prices are too high, it's better to wait a bit, hold on to your cash, and buy when a good opportunity comes. Because if you buy when it's cheap rather than when it's expensive, you can still make a profit even if the stock hasn't surpassed its previous high. There are hardly any investors who always hold 100% cash, but you should at least keep some cash on hand at all times. Even if you don't have much, it's good to keep about 10% in cash, and if the market seems too expensive, you can increase it to around 30%. Then, when good stocks drop as the market fluctuates, you can use that 30% as an opportunity to buy. I think this will help you manage your portfolio overall. This company, Advanced Reduced Instruction Set Computer Machines, is a company that designs central processing unit architectures. They sell the IPs, which are intellectual properties they design, to semiconductor companies through licensing or royalty models, and that's how they make their profits. There are two types of income, license income and royalty income. License income is a one-time contract fee that they receive from companies that design or manufacture semiconductors in exchange for granting them the rights to use this technology. In the case of royalty income, it's like a running guarantee. Every time a semiconductor chip is produced using this technology and shipped out, they receive a certain amount as royalty. So, since they get paid depending on how much is produced and sold, they have both license income and royalty income. So when the semiconductor market is doing really well, royalty income increases tremendously. That's one of the aspects involved. Based on the most recent quarterly data, out of $1.24 billion per quarter, license and royalty income are almost evenly split. So, the revenue from licensing and the royalty income generated when semiconductors or chips are produced based on those licenses are roughly split evenly, creating a stable overall flow. According to recent articles, even NVIDIA, its latest Blackwell product, uses the Advanced Reduced Instruction Set Computer Machines architecture, and the market share of Advanced Reduced Instruction Set Computer Machines, its semiconductor central processing unit architecture, has been steadily increasing over the past 5 years. So 5 years ago it was at 38%, but it has steadily increased, and according to the most recent annual data, it has risen to about 49% So, in the overall market for making semiconductor chips, advanced reduced instruction set computer machines now holds about 50% of the market share. Other than that, there's something called x86, which is an architecture originally created by Intel. They're working on this together with advanced micro devices, but their market share has been gradually decreasing. There are also some other architectures, but in any case, in the field of central processing unit architecture, advanced reduced instruction set computer machines is currently number one and is a very powerful company that continues to expand its market share. However, one disappointing point is that with about a month left before the earnings announcement, Wall Street's forecasts for revenue and earnings per share have been slightly revised downward, which is something we should keep an eye on. So the semiconductor market needs to improve for production volume to increase, but in the long term, due to technologies like artificial intelligence, we all agree that semiconductor production will continue to grow. There's really no one who disagrees or thinks otherwise. However, since production volume tends to fluctuate a lot, it seems that revisions and earnings estimates are changing quite a bit. Recently, although not by a large margin, earnings estimates have been slightly lowered. Compared to other semiconductor companies like Nvidia, Taiwan Semiconductor Manufacturing, or Advanced Micro Devices, which are showing very strong performance, this is a bit disappointing. We should keep an eye on this and check whether earnings forecasts will go up rather than down in the future. It would be good to make decisions while monitoring this. Is it a blue chip company? It has a score of 74 and its smart score is in the top 6% among all listed companies in the United States, so you can just consider it a top tier blue chip stock. There's nothing special to see. If you look at this pentagon compared to last year, it's a bit different. Last year you can see this faintly colored area, and the area I drew in red is this one. Compared to last year, financial soundness has improved and profitability,
so the margin rate,
has gotten much better. And although cash generation has slightly decreased, it's still a high-quality stock with significant growth potential. That's how we can see it. Through these 5 items, not only do we score based on the company's fundamental data, but we also include future earnings consensus. So looking at this scoring itself means we're conducting fundamental analysis. That's how you can see it. If you look at the SMART score over the past year, it was 72 points around this time last year, and now it's 74 points, so it's increased by about 2 points. A score in the 70s puts it in the top 6%, which means it's a top quality stock. So you can interpret this as the company maintaining the characteristics of a good business for quite a long time. Let's take a look at the financial chart. The financial chart is designed so that beginners can easily understand the flow and patterns of a company's financial statements at a glance. You can see all of these for free if you come to Choice Stock and search for a stock. So I think it would be great if you make good use of it. The recent onshore production standard refers to the sum of the last 4 quarters, or in other words, the total for the past 12 months. Sales reached $4 billion, up 23% compared to the same period last year, and earnings per share surged 58% to $0.75, showing that this is a rapidly growing growth stock. If we look at operating profit and net profit as well, they've reached record highs, entering a phase where the profit figures are improving significantly. And now if you look at the operating margin, it's at 20.7%. You can see that the margin has been steadily improving from the lower levels in the past, right? But what you really need to pay attention to here is the net profit margin. The net profit margin is shown in green and the operating margin in blue. In the past, you can see that the gap between the two was quite wide, with the net profit margin being higher and the operating margin being lower, meaning the operating margin was relatively low. There was a period where the net profit margin was higher than the operating margin, but recently they've almost converged. Now the net profit margin is at 19.8%, which is actually lower than the operating margin of 20%, something that hasn't happened in a long time. So if the net profit margin drops, it means the net profit itself will also decrease. It's not that the overall amount is getting smaller, but rather that the net profit margin is decreasing, which could mean the net profit growth rate might slow down. It's important to interpret it this way. It's also crucial to check why this is happening and whether we're entering a period where the net profit margin will continue to decrease. Generally, the net profit margin is lower than the operating margin. That's because there are operating profits and losses, financial gains and losses, things like interest and corporate taxes to pay. So in most cases, the net profit margin is lower than the operating margin. But this company had a high net profit margin for quite a long time and then it suddenly dropped. So, determining whether this will reverse and drop even further is going to be a very important part of interpreting the overall scale of advanced reduced instruction set computer machines' net profit. So I looked it up in the original income statement, and as you can see here, we're looking at the operating profit on a quarterly basis. If you look at it on a quarterly basis, in the first quarter of last year, it was $36 million, $62 million, and $93 million in profit, all in the black. They also made a profit outside of operating activity. So if you look down here, the operating profit last quarter was $170 million, but the net profit was $250 million. And before that, the operating profit was $64 million, but the net profit was $100 million. There are these kinds of trends that make this possible. If you look at the previous quarter, the operating profit was $180 million, but the net profit was $220 million. These are cases where profits outside of operating activities added to the net profit and made it bigger. But if you look at the data from the most recent quarter, the operating profit increased a lot. We saw $410 million. So the sales growth is also really fast. It reached $410 million, but the net profit is $270 million. It should have been a positive trend like before, but in just one quarter, there was a loss of $260 million from non-operating activities. That's why the net profit from operations decreased. So when we analyze this company, what we see is that in the first quarter, the operations were very strong, but there was a problem in non-operating activities. It's important to check what that problem was and to determine whether it will continue or not. This is crucial for making investment decisions. So I looked into this part, and when I checked the losses in operations through the electronic data gathering, analysis and retrieval filings, there were mainly two reasons. One is foreign exchange loss and the other is derivative loss. This might be a bit difficult to understand, but a foreign exchange loss refers to a valuation loss that occurs due to fluctuations in exchange rates. A derivative loss refers to a case where a company holds derivatives, whether it's futures, options or swaps, and because the prices of these derivatives fluctuate, futures change, options change, everything changes. The losses that occur due to these price changes are called derivative losses. But why did this happen in the case of this company, Advanced Reduced Instruction Set Computer Machines Holdings? This company has some of Japan's major semiconductor companies as its main clients, such as Renesas, Sony, and Toshiba. About 27% of Advanced Reduced Instruction Set Computer Machines Holdings' total sales come from Japan. So they make sales in Japan, and then the money shown here in Japanese yen is issued. In other words, the accounts receivable are based on yen. About $470 million worth of accounts receivable in Japan are denominated in yen. So they're supposed to receive that money, but since it's in yen, they'll later convert it to dollars and reflect it in their financial statements. Then, if the exchange rate changes, if the yen's exchange rate changes against the dollar, the value of those amounts will also change, right? For example, let's say you went on an overseas trip and came back with about $100 left. Let's say the exchange rate was 1,301 when you went on vacation and you had $100. But after a while, the exchange rate went up to 1,401. Then, even though I still have the same $100, if the exchange rate goes up, what happens? You get an appraisal gain of 101 per dollar, right? On the other hand, for someone who has to pay $100 before they only needed to pay 1,301, but later they have to pay 1,401, this kind of situation happens. So this happens due to exchange rate fluctuations. In the case of Advanced Reduced Instruction Set Computer Machines Holdings, these two things, foreign exchange gains and hedging related to the Japanese yen, which is called derivative hedging, are actions we take to avoid risk. We sign up for these products to avoid risk, and canceling them is called risk hedging. So when the yen exchange rate fluctuates, what it means to have less loss from these changes is that we make a profit by taking the opposite position when the exchange rate drops. Even if it falls, we can offset the loss by having that opposite position. They sign up for these kinds of products as derivatives to fix their overall profits, and these are called yen hedge derivatives. So that's where the loss happened. What that means is that things went in the opposite direction from what Advanced Reduced Instruction Set Computer Machines Holdings expected. So if you look at the first quarter, what happened was, this is the yen-dollar exchange rate chart. If you look here over the past year, it was 140 yen per dollar, and then it went up to 156 yen. That means the value of the yen dropped. This is actually the hardest part when you first study exchange rates. The difference between the value dropping and the exchange rate going up. It's always confusing, but when the exchange rate goes up, it means the value is dropping. So it's a matter of whether you explain it based on value or based on price. In our country, if the exchange rate goes from 1,301 to 1,401 per dollar, that means the exchange rate has gone up. When we say the exchange rate has gone up, it means the value of the one has dropped. In the case of the yen currency exchange rate, if it drops from the 1,401 range like this, it's highly likely that they signed up for some kind of derivative product that prevents losses when it drops like this. But suddenly, the value of the yen currency plummets in the opposite direction. As the value of the yen drops and the exchange rate rises, they incurred valuation losses on their yen-denominated accounts receivable and derivative products, and those valuation losses amounted to about $260 million in the quarter. What we're curious about is this quarter, so we're wondering what will happen in June, September and December. Now we can't know exactly how advanced reduced instruction set computer machines has positioned itself. We'd have to look inside everything, but even if we keep going up from here, if we look at the position that doesn't take a loss, it ends up being the opposite. Now the exchange rate has dropped again, it's returned to normal. So there is a significant possibility that some problems could arise, but for a typical company, they usually don't take this kind of position. So if the exchange rate drops back to its previous level like this, I think there's a good chance that the amount generated from derivatives or sales receivables, like the $260 million that occurred in the first quarter, will decrease significantly. So as operating profit increases, there's a possibility that net profit will also increase in the second quarter. However, the fact that the consensus is dropping a bit now is a bit of a risk, as I mentioned earlier, so it's something we need to keep an eye on. Since the value of the yen has dropped and the exchange rate went up, but now the exchange rate has fallen, it seems there won't be as much difficulty this quarter as there was in the first quarter. I think it's reasonable to look at it that way for now. In the end, if we establish the structure of companies like advanced reduced instruction set computer machines, we'll be able to predict how things will play out when the exchange rate rises and how they'll play out when it falls. That was a bit complicated, but I think it would be good for you to understand it before we move on. If you look at the cash flows from operating activities, investing activities, and financing activities, you can see that it's plus, minus, minus, which means the company has the cash flow of a solid business, and the cash flow from operating activities is quite large. And since this company is a direct property, an IP company, as an IP company, it probably doesn't own things like equipment or facilities. And there probably isn't anything like raw paper. It's more that people, the workforce, are creating and developing things. So there aren't things like inventory assets or accounts payable here. Accounts payable only occur when you have to buy raw materials, and inventory assets only occur when you make products. If you check this company, only accounts receivable occur, and the accounts receivable turnover days are consistently maintained to some extent, so it's not a big problem. That's how you can interpret it. Next, if you look at the earnings per share and stock price, what's a bit unfortunate is that compared to how much semiconductor stocks have risen, ALM Holdings has been stuck in a box range since it was listed. If you look at it broadly, this box range is actually quite high. The upper end is $180 and the lower end is around $70 or $80, so it fluctuates between $80 and $180. That's a big range, but it's still a box range. However, it hasn't completely broken out of this range yet. So right now, it's staying within this range, but the earnings per share keeps building up like this. Since the earnings per share continues to build up the company's value at the bottom, I think there will come a time when it eventually breaks through the previous high. So in the end, I think it's a matter of timing, depending on how much faster this earnings per share grows and how much sooner it grows compared to expectations. I'm not saying we should buy right now. It will depend on this earnings per share growth rate. However, the stock price still hasn't broken through its previous high, while the company's value continues to build up step by step. This is what we can consider as the current corporate value of advanced reduced instruction set computer machines holdings. If we look at the projected performance, sales are expected to grow by about 20% annually over the next 3 years, and earnings per share is projected to grow by 48% and 27%. At this level, it's a company experiencing rapid growth. Compared to that, the stock price is still stuck in a range and hasn't broken out. That's because the stock has been trading at a high price for a while, but as the company's value continues to rise, even if the stock price doesn't go up, it will eventually enter an undervalued area. I think that's probably when the momentum will come out strongly. If you look at the valuation, as you can see here, there's a lot of red. When there's a lot of red, it means it's in a highly overvalued area. ALM Holdings was rarely undervalued. It was overvalued for a long time, but take a look at this yellow area. At this point, it broke through the undervaluation line for the first time and dropped into a very undervalued area. This is the best time to buy the stock. Now, it's gone back to being overvalued and is currently converging toward a fair value level. This band of the line will probably keep rising like this as our company's value increases, like this. So if the stock price drops like this, it becomes undervalued here. And as the stock price moves like this, in the long term, there's a possibility that it could break through the previous highs and become overvalued again. When will that happen? For those who are investing with a 3-month outlook, do you think it will break through the previous high? It's unlikely in the short term, but if you look at it over a longer period, the chances of breaking through are much higher. I think that's the right way to interpret it. Looking at the stock momentum, this one also recently gave a buy signal, which is basically a golden cross. That means an upward trend has started. But just because this happened, we don't immediately issue a buy signal in our trading system. So it would be good if you could use those aspects together as well. Or I'll move to our website, briefly go over the current situation, and then wrap up. Looking at Advanced Reduced Instruction Set Computer Machines Holdings, it's currently a hold signal, and the buy signal appeared at $123. So this company has only had a buy signal twice. There was a buy signal at $143 last December, but it was probably too expensive to buy since then. And then after making a 1.17% profit, something seemed off, so a sell signal was triggered. And then, after buying again at $123, which is cheaper than before, it's currently up about 19%. If you look at the data now, we also provide you with these kinds of price points. If it goes over $170, it enters the overvalued range, and if you look below here, there's the highly overvalued area. If it goes over $200 to around $220, it becomes very expensive. So between $170 and $220 based on the current value, it's a valuation range where you should consider selling in portions. That's how you can look at it. It's the yellow area I mentioned earlier. If you make good use of this chart, since it's really difficult to evaluate the valuation of stocks, I think it will be helpful for your investments if you use it well. If you look at the trading signals, Advanced Reduced Instruction Set Computer Machines Holdings had a sell signal at this point, so I didn't buy it for a while. Then after it turned and I could clearly confirm it, I bought it. And now it's up about 20%. So I hope that referring to things like this will help you with your investments. So let me say again, I'm not recommending you to buy these stocks right now. I'm emphasizing once more that this is how you interpret things based on data. If you found this video helpful, please subscribe, like, and turn on notifications. Thank you.